Hello everyone, welcome to our latest Money Chat series. I'm Nova Lui, RHB Bank's Head of Investors Advisory. Today we are honored to have Robert St Clair joining us to share his view on the recent Fed rate hike and Fullerton's view on major issues that is still driving the equity market, and Fullerton's house view on investment strategy that can make positive return in medium to long term. Robert is the strategist for Fullerton Fund Management and reports directly to the Chief Investment Officer. He works closely with the CIO to formulate and drive the global investment strategy across asset classes. In his role, he is responsible for communicating Fullerton's house view to clients, consultants, and the media. Fullerton is an Asia-based investment specialist with capability that span equities, fixed income, multi-asset, and alternative, including private equity, headquartered in Singapore. Prior to the establishment of Fullerton Investment Team, operates as an internal fund management division within Temasek. Fullerton is incorporated in Singapore in 2003 and is a subsidiary of Temasek Holdings. Hi, Robert. Thank you very much for making time to join us.
Thank you. It's a pleasure to speak with you.
On 27 July, Fed has raised another 75 basis points in interest rates, which in total Fed has hiked rate by 225 basis points this year. Nasdaq jumped 4.1% on the same day on this announcement, while S&P 500 was up by 2.6%. With such positivity shown in the equity market, do you think this rate hike has been highly anticipated, and would market already price in most of the rate hike for the year?
Yeah, so I mean, of course, US inflation is still high and wage pressures are significant. And so therefore, I think it does seem that we do need to have a few more rate hikes. And that is what is priced in by financial markets at the moment. So as you pointed out, the latest hike of 75 basis points in July takes us to 2.5%, and the market is expecting, along with the Fed, that they will reach 3.25% by the end of the year. So at the moment, we're probably about 3/4 of the way through the 2022 tightening cycle. And we have a slide that shows the market pricing in of the rate hikes to come. I think where the key uncertainties still remain, of course, is the outlook for next year. And we can see that in our slide 1, where it also shows that US interest rate forward market pricing is quite worried about recession risks and is actually pricing in rate cuts for next year. But of course, that is not the Fed view. They do believe that the US economy can achieve a soft landing, in part because corporate profitability is robust and balance sheets are strong. So on that basis, the Fed may not cut interest rates in 2023. It'll wait until inflation falls significantly before perhaps easing in 2024.
Inflation is still rising exponentially. Some central banks are scrambling to raise interest rates to arrest inflation from further increase. However, recently we start to observe some reversal, especially in soft commodity prices. In your opinion, is inflation nearing its peak in US?
Yeah, so it's still a significant problem, of course, in the US to rein in inflation because it is being amplified by multiple drivers at the same time. So we have the excess demand pressures, we have the very high energy prices, supply chain bottlenecks, and of course, rising wages. What we try to show in slide 2 is that there is still quite mixed signals from the inflation data in the US. So goods price inflation and PCE inflation, that may be around its peak, but the CPI inflation may still be rising. And of course, US wage inflation is also quite high, and that will take time to come back because of the relatively tight labor market. So I think on balance, it is still probably too early to judge if US inflation has peaked, which I think is another key reason why financial markets and the Fed still expect further rate hikes this year.
Robert, the Russian-Ukraine war, which unfolded in February 2022, has partially attributed to the beginning of the bear market this year. We have yet to see any sign of conflict ending anytime soon. How much more is this expected to impact the global economy and global equity market?
Yes, you're right. I mean, it's been obviously a very significant shock. And of course, the spillovers from the Russia-Ukraine war have had their biggest adverse impacts on global investor sentiment, as you pointed out, on confidence, and of course on inflation as well, especially across the sectors where Russia has been an important global exporter. So that's things like oil prices, European natural gas prices, and food prices. Global producer price inflation has surged because of the high raw material costs, commodity prices, and transport costs. And of course, Europe has suffered by significantly more than other regions, largely because of the surge in energy prices. So altogether, this is placing significant downward pressures on corporate margins, earnings, and equity market, as we illustrate in slide 3. All of these stresses could continue for some time. There may only be some relief after demand destruction drives significant falls in commodity prices. We've already seen some of that, where oil prices have fallen back from their extreme highs of around $130 back in March, as there were more concerns about slowing consumption growth, especially across China and India.
Okay, it seems like the Russian-Ukraine war is still a major event that we need to watch out for. Dear investors, this is a very good opportunity that we have Robert with us here today. If you have any question, feel free to put down in the comment box below. We will try our very best to address it as soon as possible. Again, Robert, on the US and European market, it's highly expected that we'll fall into recession either by this year or latest by next year. This is somewhat deter investor appetite to invest into developed market equities. What is Fullerton's view on asset allocation within developed and the emerging equity markets?
Yeah, so I think even in the worst case scenario of a global recession, different countries are likely to suffer to different degrees, which will certainly influence asset allocations and can create investment opportunities. So, for example, China is already out of phase with developed markets as China is rebounding from its COVID control lockdowns with significant policy stimulus. And I think combined with improved investor sentiment and favorable valuations, China's equity market could continue to perform well against other developed markets, as we have seen since March this year, and as we show in our slide number 3. I think if a global recession does unfold, then of course Asia could prove to be better placed than other countries to be able to provide more targeted and timely stimulus to support growth, in part because the inflationary pressures in Asia are not as strong as what they are in developed markets. So we've already talked about, of course, Europe is suffering a lot from high producer price inflation to a lot larger extent than most other regions, which of course is feeding into higher wages and the CPI, and is stressing margins and equity market performance. So for us, from Fullerton's perspective, against this backdrop of differentiated regions and recession risk, the markets that we favor the most, and we focus a lot from the bottom-up perspective in terms of sectors, especially across China, is where we still have these positive drivers like rising per capita incomes and productivity growth, which can give some insulation from downturns and of course can aid faster recoveries from sell-offs. So the sectors that we are more positive on comprise things like technology, e-commerce, consumer products, healthcare, financials, and renewables, as we try and summarize in our slide number 4. And I think it's important to remember that as a long-term investor, it's important to keep focused on fundamentals, especially on growth stocks where a company has strong financials and good branding and a good positive record of growing its market share over time. Even when recession fears are significant and equity markets are in bear market decline, there can still be attractive opportunities for investing, especially in defensive stocks versus cyclical stocks.
Okay, it seems like there are still some headwind risks ahead of us. So as of 22nd July 2022, most major equity market, including US and China, have suffered double-digit losses. We understand Fullerton has a few funds with TA Investment Management that are managed based on absolute return strategy. How would an absolute return strategy be beneficial in the current investment environment, Robert?
Yeah, so we kind of always step back and say, well, when you're trying to navigate very challenging financial markets, first and foremost, investors should try and make sure that they are comfortable with their degree of leverage and risk exposure, and that they have sufficient defensive strategies in place to give downside protection. So that means making sure that there is enough holdings of assets like gold and to a lesser extent cash, I guess, denominated in appreciating safe haven currencies, because that can give potentially some insulation against high inflation and further downside risk to growth. Investors can then consider having some spare resources to deploy to take advantage of any of the opportunities that can unfold, because even in bear markets there can still be relative winners across different sectors and countries. And so this is really where we believe that the flexibility of an absolute return strategy comes into play, because you're not so constrained by benchmarks. Investors can raise defensive instruments as well as being able to consider underweight and overweight positions across different sectors and countries that you typically don't see in a relative return strategy. And so overall, this actually helps an absolute return strategy achieve its primary objective of trying to deliver positive returns to investors, regardless of whether markets are rising or falling.
What about socially responsible investing? Such principles like Sharia-based investing, ESG investing, that can be seen as part of the screening methodology in the portfolio management. How would such strategy benefit an investment portfolio, Robert?
Yeah, so Fullerton is committed to the UN principles for responsible investment. And what that means is that we view environmental, social, and governance issues as an integral part of assessing investment opportunities. And so, as you point out, what that requires is considering the key ESG considerations like climate change, health and safety, data security, and governance as a key part of the research process when you are looking at investment opportunities. And often the way we do it is we think about a scorecard ranking. And that allows us, I guess, to focus on social responsible investing from a risk management perspective, but also as a potential source of alpha. Because one of the key benefits from responsible investing is that research has shown is that there is clear evidence that companies with good ESG management can get extra earnings and higher returns because customers do demand more sustainable growth models. And when we think about Asia, it's certainly true that there is some catch up in terms of setting ESG targets. But in many respects, that means investors can capitalize on the investment opportunities early in the growth journey. If we look at Asia, investors can benefit from spillover opportunities across infrastructure that will drive the ESG transitions, as well as benefiting from investments directly in companies that are fostering the green engine, because many Asian companies are global leaders in environmental technologies.
Very well. Thank you very much for your sharing today. I trust your insight will be helpful for our investors to make informed investment decisions while getting to know more about absolute return strategy in this volatile market. Dear investor, TA Asia Absolute Alpha uses absolute return strategy, investing into equity which have operation in, has exposure, or derive part of their revenue from Asia Pac region, wherever they may be listed. Since its inception in May 2020, the fund has achieved 25.3% return, outperforming the Asia Pacific ex-Japan index and above its benchmark return of 8% per annum. To know more about other funds that may be suitable for your investment portfolio, please scan the QR code below to view our quarterly fund discoveries ideas. Thank you very much again, Robert, for joining us today.
Thank you. Pleasure to talk with you.